India's mobility landscape operates at a massive physical scale. With tens of millions of two-wheelers traversing the country daily, the high density of internal combustion engines forms the foundation of a significant electric transition. The mechanics of this space are shifting. Market analysis suggests that the adoption of electric two-wheelers in India is moving toward a 20% penetration rate. This transition is supported by the fuel cost arbitrage between petrol and electricity, alongside federal incentives like the PM e-Drive program and production-linked incentives designed to lower the barrier for domestic manufacturers. Ola Electric was built to capture this shift. Supported by institutional capital and the automated Future Factory, the company initially commanded a 40 to 45% share of the electric two-wheeler market. On paper, Ola aligned market timing with industrial capacity and capital backing, positioning itself to control the mobility ecosystem. The data shows a significant contradiction. While India's overall electric vehicle penetration continues to rise, Ola's stock price has declined 85% from its post-listing highs, as its market share contracted into the low double digits. A major driver of this decline is the expansion of net losses, which reached over 2,200 crore rupees by fiscal year 2026. This trajectory led auditors BSR and Company to include an emphasis of matter regarding management's assessment of the company as a going concern. The audit identifies negative operating cash flows, stating Ola requires external funding to meet liabilities and continue operations. We are analyzing Ola's financial filings to determine if the company is a mispriced energy play or a hardware-heavy operation facing a liquidity crisis. Ola's revenue profile remains tied to manufacturing. Despite its technology-focused branding, 85 to 90% of current turnover is generated by direct sales of the S1 scooter series. Management intends to use these hardware sales to build a high-margin services layer, including MoveOS software updates, data services, and Ola Care subscriptions. The core of this strategy is the transition from imported battery packs to in-house production of 46-100 lithium iron phosphate cells at the company's Gigafactory. This requires a strategy of deep vertical integration, where Ola owns the cell manufacturing, software development, vehicle assembly, and direct retail centers. This approach creates a capital expenditure cycle, where the cost of building cell plants and retail networks outpaces the cash generated from current vehicle sales. The model prioritizes long-term theoretical margins over short-term financial stability, necessitating constant cash injections to sustain the path to scale. As Ola scales, the competitive environment has shifted. Established manufacturers like TVS and Bajaj have expanded their electric portfolios to capture roughly 45% of the high-speed market. These incumbents utilize dealer networks of over 5,000 touchpoints, whereas Ola relies on its own restricted direct-to-consumer centers. This limited service footprint has contributed to brand challenges, including reported software issues and significant after-sales service delays. However, shifting to the Gen 3 platform improved unit economics. By reducing parts and increasing component integration, Ola increased gross margins even as market share declined. Controlling the cell-to-software stack provides a potential cost advantage, assuming the company reaches the necessary volume. While vertical integration yields margin improvements on the assembly line, operational failures in service and retail currently offset these technological gains. Analyzing financial statements reveals a gap between sales and liquidity. This waterfall chart shows that despite revenue growth, the company reports deeply negative operating cash flow. A significant divergence between stated net income and actual cash from operations indicates rapid cash consumption. The capital drain is visible in the company's balances, which dropped from over 4,000 crore rupees to roughly 2,089 crore within several months. The Tijori red flag report indicates that capital allocation is focused on vertical integration and the Gigafactory, without signs of unrelated diversification. However, the report lists a risk regarding baseline economics, as the consolidated entity continues to report losses despite improved unit-level margins. This burn rate makes the proposed qualified institutional placement necessary to replenish liquidity and continue the Gigafactory scale-up. Ola is attempting to reach profitable scale before its current capital reserves are exhausted. The bull case relies on the successful integration of 46-100 cells to achieve the lowest manufacturing cost in the domestic market, enabling B2B battery sales and software monetization. The bear case suggests that legacy competition and brand damage will prevent the company from reaching the volumes needed to offset its high capital expenditure. The path forward depends on management's ability to execute complex industrial manufacturing before their cash reserves are exhausted. The market currently penalizes Ola for its high capital requirements. It is being priced closer to a hardware manufacturer than the technology ecosystem management describes. This is reflected in the significant valuation markdowns reported by institutional investors like Vanguard. Until the company generates positive operating cash flow, its industrial hardware multiples. Scorecard. Macro opportunity scores 9 and 10. Operational metrics show vision at 7 to 8, execution 5 to 6. Financial strength is 4 to 5. We categorize Ola Electric as speculative growth. It represents a hold for high-risk portfolios, but remains a risk for capital focused on fundamental cash flow stability. The company's ecosystem vision remains tethered to its hardware performance. Success now rests on reaching industrial scale while navigating a narrow financial window.